Mohit Pachisia, and my qualification, by way of qualification, I have completed 2 levels of CFA, all CMT levels, and which is Chartered Market Technician, and also I am an EPATian. So EPAT is a course in algorithmic trading, a formal course in algorithmic trading. So since a lot of my education was leaning towards finance from the very beginning, my interest was in trading more than it was in investing. I started with understanding technical analysis, and with time, I understood that the first people who actually delve into algorithmic trading, even before there was HFT or anything, were the technical analysts who would put their ideas together. So, like that way, I got a natural inclination to try and automate my ideas, which I've been putting since many years on the charts. That is how I entered algorithmic trading. And obviously, a lot of education went behind learning to code because I didn't come from a science background. And now I have felt that everybody can do it, and it is not something which is very difficult. So for those who are very, very new to the world of algorithmic trading, if they are coming from the finance background, then this session will make them understand that coding is doable. And if they come from a coding background, it will make them understand that the ideas you can put up in finance and give you some framework to work on with your coding skills. Okay, so this session is good for both the category of people and those who are watching this recording. Please watch till the end because we're going to do a lot and we're going to express a lot about a trading strategy. Okay, so moving on. So what do we need if we want to actually build a career in finance? First thing which we need in order to make a career in finance is some sort of background. And when I say finance, in the sense a career in quantitative finance or career in algorithmic trading, you need some knowledge of this. Okay. Now, what I'm saying does not have to be college education. It can be acquired as you are working in the industry, as an individual or as an employee. Okay. So you need some background of finance domain. So when I speak about the finance domain, I mean to say that any of the sciences, like for example, fundamental analysis or technical analysis, or in case when you're looking at long-term portfolios, then something to do with economics also. Okay. Apart from this background in the finance domain, you need understanding of programming and data. Just a second. Just 1 second, guys. 1 second. Yes. So you need the programming skills. Alone by itself, a program is not enough. Alone by itself, something like technical analysis is also not enough. Okay. So you need to mix both these two. And if you lack in any of these, it is better to start acquiring knowledge of the thing you're lacking. Right. Then once you are having an overlap between these two, you understand what are the types of algorithmic trading strategies out there. You have to build an understanding of that. And the reason why you have to build an understanding is because all of us, in order to succeed in algorithmic trading, we need to have a particular something called a framework. Okay. Basically a flow, right? And when I design a flow of an entire process, as you see in a factory, there is an assembly line. Suppose a factory is making, say, toothpaste. Okay. So there is a lot of paste which is there. Then you put it in tubes. Then you pack, the cap is put on, right, on the tubes. Then the tube is going into a small cardboard packaging. And then eventually it is going to the stores, right? It is going to the truck and so on. So this entire assembly line is an organized way or a process of creating a product so that it can be used in the market. Just like that, here we have a product. Now, the basic difference between trading through discretion and trading through algorithms is known to everybody. Everybody knows that what is the basic discretion between or difference between algorithmic and manual trading. Can I have some answers? What is the basic difference? Or it could mean also the basic difference between manual portfolio management and algorithmical or quantitative portfolio management. What do you think is the difference? What comes to your mind? Can I have some answer on the chat? You can just give a few words, that is enough. So Hemant is saying automation. That is one of the difference, right? Any more?
I guess we can by automation.
Yeah, I would suggest speak on the chat because the webinar is in progress right now.
Sorry,
so
yeah.
everybody will then do that and some background noises come. Yeah, don't mind. Yeah. So, yeah. So can you just message? Okay, so somebody says automation. Then one of the reasons is again the emotional part of trading, the trading psychology issues. Like Mr. Anshu is saying, automation without psychology and emotions. Rahul is saying mathematical strategies. So he means to say mathematical precision that comes in with the algorithmic strategies. So all these answers are correct actually. So what is actually happening is that when we are doing trading, when we are looking at any aspect of the market, say fundamental analysis or technical analysis, we are trying to take some concepts, right? We can actually look at a long-term trend, then we can look at a short-term trend, we can look at some candlesticks, perhaps some patterns, perhaps some indicators and whatnot. And somewhere or the other, we find some conditions and overlaps. And we find some assumptions that, okay, because these indicators are pointing towards the buy direction or the long direction or the upward direction, we can go long. So all of that is somewhere or the other subjective. In the sense, it is qualitative. It is not quantitative. Unless I quantify it. Okay. So everything to do with quant finance is about making your venture quantitative. Okay, Ashray says by algo we can buy and sell with correct stipulated time. Yeah, so timing, precision, these are the common answers I'm getting, right? So the first most important thing is that we look at the qualitative aspect first. Okay, just a second. Whenever I start writing in front of students, I always make spelling mistake. Okay, so qualitative. Why is it that we need to understand the qualitative aspect first? It is because only and only qualitative ideas can then be quantified. By itself, quantifying is not a foolproof thing, right? You need something to quantify. So whenever we speak about quantitative finance, from what I have gathered over my 11 to 12 years experience in the market, actually more than that, but 12 years of professional experience in the market, I will say that people are not understanding when they say quant finance, you're quantifying something. What is that you're quantifying? So that is equally important, if not more. Now, when we have got the background of some science of the markets and market analysis and some programming skills, both put together, we can make a quantifiable understanding of something like a back test. Okay, so we'll talk a little more about those things as we go ahead. First, let's understand what are the different types of algorithmic trading strategies out there. Number one, we have a high frequency strategy. Okay, now the reason I could have put them in some other order also, but since we have it in the smallest to lowest, smallest to highest order, we'll go it that way. So high frequency trading has become very popular, and a lot of people are getting, especially students I see, are getting attracted towards it. Nothing wrong, that's very great. But let's understand that all of these different types of trading have their own pros and cons and own idiosyncrasies. So high frequency trading means that you are trading within nanoseconds, within even less than milliseconds. Okay. So the number of transactions are very, very high, and high frequency trading firms generally have very small cost. So they are themselves the members. So the brokerage is very less. Sometimes they get rebate from the exchanges, and those kind of things happen. The technology part of high frequency trading is something which is high weightage. So if I'm talking about somebody doing high frequency trading, one of the most important things they need to know is the technology behind it. I mean to say everything from the hardware to the software, and coding wise, they need to be very firm with that, very clear with that. Okay. So high frequency trading involves the high frequency trading firm having their servers co-located with the exchange and getting absolutely lowest latency, as low as possible, on their signals and trades. Okay. Then this gives us an understanding that this is not something you can sit and do at home, right? You can obviously you can model the strategy at home. You can model the high frequency strategy at home, but you cannot execute that like like a regular person, unless of course they have the given level of computation and the technology and the the data from some other place, right? So there's not somebody regularly can pick it up that easily in terms of execution. Then comes the mid frequency and the low frequency. This is something which people like you and me can do, which is, and not just people like me and you, there are many firms who do that. There are many companies and financial services companies who do that. So what does medium frequency trading entail? Well, theoretically, it means something which is short term or intraday, or a few milliseconds would not hinder the results of our trades. In high frequency trading, even a few milliseconds can hinder the results of the trade. But in mid frequency trading, it will not hinder the results of the trade, right? So you have got something like an intraday trade or an hourly chart based trade, which will last for 2 to 3 days. All of this is mid frequency trading. Okay. You can have a 5-minute chart trade, and that can be mid frequency trading. And then there is low frequency trading. That means the frequency of trades is actually pretty low. You can have like 5 or 10 trades a year in such a trading strategy. With low frequency trading, the positive part is that it looks to catch very big market moves, substantial market moves, and it takes very low transaction cost into account. But the not so good part of low frequency strategies is that the holding, you have to hold them for a pretty long time sometimes. Okay. So with mid-frequency trading, suppose I have a trading, I'm trading an intraday strategy, which is a mid-frequency, and something which is like a long-term strategy, which is low frequency. With the intraday, I will get the result within the day, but the low frequency trading will take a while for me to give, for it to give me the proper results. Okay. But all of them have their advantages, all of them have their limitations and challenges. So what we need to understand is, first of all of these are different types of alphas. Now, what do we mean by the word alpha? If you are in quant finance or data science for finance, you will often hear this word alpha. Now, in terms of finance, alpha means that if there is a benchmark, generally a benchmark is taken as an index or a universe, index universe. Basically, if I'm looking at the benchmark for my long-term strategy or a portfolio to be something like Nifty 200 or Nifty 500. Okay. At the same time, I have a strategy which is trading only the Nifty index. So here my benchmark is Nifty 50. Something which is basically forming a yardstick, a benchmark to see if my strategy returns are say 10% in a period of 3 months. And Nifty, if I buy and hold Nifty for 3 months, my returns is say 4.5%. So here, for this 3-month period, generally we do it yearly when we calculate our alpha. But for this 3-month period, I'm getting a 5.5% alpha. Okay. So the goal often is to beat the benchmark when we are thinking of any kind of trading strategy. Okay. Now, obviously, alpha is important, and I will make a list over here. Total returns is important. Now, let me give you an example. Let's say, for example, there is a strategy which has an equity curve that looks like this. And there is another strategy which has an equity curve that looks like this. Which one? This is number 2 and this is number 1. Which one would you like to put your money in? Which equity curve would you like to put your money in? Number 1 or number 2? Can I have some answers, please? Great. So I'm getting the maximum answer to be 1. People are answering 1. Nobody wants to put their money on number 2. So here we understand one thing, that we just don't need a very high level of total returns. We need something what we call in finance risk-adjusted returns. Okay. Here we will see parameters like standard deviation or Sharpe ratio, Sortino ratio, Kalmar when it comes to the drawdown and so on and so forth. Okay. So we will understand one thing, that the strategy should give us alpha. It should give us total returns which are good, but it should also give us stable returns. Okay. So whenever we're speaking of algorithmic trading strategy, we look at this sort of stability in our venture. Okay. Now, if regardless of what kind of strategy you have, a high frequency, mid frequency, or low frequency, each one will have different types of alphas, and you have to figure out what is the best alpha, the best risk-adjusted return basically, and the best beating the benchmark, where you can make a strategy portfolio or at least have one trading strategy to begin with. You may put your own money or you may find investors to put money on your strategy. Both are possible, both are happening in the market. But the first thing is that let's have a robust strategy. That is what we will move towards now. Now, in order to model a robust strategy, there are 2 approaches in general. Since there is a limitation of time, I'm not going to go into the second approach today. So the general approach is 1, using technical analysis indicators, something around price action, something around statistics, okay, and having a combination of those parameters. So there is one approach that is a traditional approach. And then there is another approach, which is the machine learning approach. A lot of you may have heard of machine learning approach, right? Now, speaking of machine learning, we'll come to this in greater details, okay? Speaking of machine learning, it sounds very interesting, but it is like a double-edged sword. It is something which needs the clear understanding, time. And even though from far away, it seems like at a click of a button, you will make a trading model. But trust me, it takes time. Every time I have worked with machine learning models, I have actually spent adequate time in not just understanding them, but even to create the model or sort of train the model, not create the model, you call it training the model, nights and nights of, some tweaks and some clarity and some optimization to be done. So machine learning is something which is super duper powerful because it can do things. It is like having the power of what in say 200 years back or 100 years back, so whenever the calculator was invented, the first time somebody used the calculator, They will like, oh my God, there's such a superpower. I can't do with my mind what this can do with the calculator. Same thing with machine learning. You can't observe those things visually, which machine learning can help you do. Okay. So let's come back to the approach and the process of actually building an algorithmic trading strategy. Until now, whatever I have I've discussed, I hope everybody is with me. Some people were a little lazy and they came in late, but I hope all of you are with me. Just type a yes or give me a quick thumbs up if you're with me. Okay. Some people are little late, but no problem. If you have any questions, feel free to ask anytime. Okay. So let's understand this. So we have, in the beginning, we have something like raw data. Here, let's take an example of open, high, low, close data. Now, speaking of quantitative finance, this data can actually become like, there could be a lot of different kinds of data. I'm talking about the very basic thing. The basic thing is the price data. Okay. So say I want to build a trading strategy. The first thing and the most important thing I will need is the price, because that is what all the backtesting is done on. But then, for example, there are institutes and there are people and there are groups of people and hedge funds who spend a lot of money, and they take something even like alternative data. So, for example, outside Walmart, there is a parking lot, and they will collect the satellite images of how many cars were actually coming to the Walmart, so that before the quarterly result, they are able to correctly predict the total sales and total profits. And if they are having that information through that data, they're able to compute that information pretty accurately, then there's a chance they can make money more easily if there's an earnings surprise in the market. So that is something called alternative data. Within data, there is also something which is called NLP, natural language processing. You have bits and pieces of news, you have articles and blogs and Twitter feeds and whatnot. All of that put together through NLP models can help you actually to estimate if this data is talking positively about a stock or negatively about the stock. So the trading model is actually including that data, which gives us a fundamental bias or a news-based bias while having the trading model. It is like having Alexa, who understands what you're saying, but also not just understands, but also understands the intensity of the bearishness or a bullishness behind the news. So these things also are done. And it's not that you get that kind of data ready-made, or any algorithmic trading model or any machine learning model can actually give you the format correct vectorization of that data in a proper way. It's not that easy. It takes time. You have to have proper clean data sources. The timing is an important thing. You want to also backtest how it would have been if you took a bunch of data 1 year back or 3 years back in order to actually make a model. So you're getting the point that this raw data can mean a lot of things when it comes to quantitative finance. And I want to not keep it only, okay, OHLC data is there and you can do everything. I don't want to keep it like that. I want to actually open up and this world to you, which is actually a very, 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 very wide variety of things. Okay. But still, for the limitation of our time and our class today, we will focus on the OHLC data. So we pull the data from somewhere. Something or the other we do to able to pull out the data. Either somebody can do web scraping or use some API for that matter, right? While doing the web scraping, or you have a broker API. Suppose Zerodha is your broker, you can pull the data from the Zerodha Kite API. Okay. So Kite Connect API helps you also. So like that, different brokers have different APIs. You can get free data through, say, for example, Yahoo Finance. I'm going to give you an example of that. And then you start modeling the data. Now, when I say modeling the data, here means whatever you have observed. Let's take some basic ideas and natural edges which are there and try and bring them together into existence. Okay, we are going to do that today in class. So that's how we will model the data. We will take some technical analysis indicators, we will take some conditions, and we will see how we could actually get information on the price which could give us consistent returns. Okay. Then comes back testing. So once I have actually put my conditions and I have modeled the data properly, that model will yield a backtest result, because I will do the backtesting that if I had a position every time my conditions were met, how would my profits be? Okay. So once the backtesting is done, then we are ready with the model. Then we say, okay, somewhere or the other, we can actually perceive that our model is ready. So for the very beginner level, I would say you can follow this process, because this process is going to help you practice. It will help you build the right framework. Now let's look at a little more professional aspect of how things are done. Let's understand how somebody can do it in a more professional way. So let's say, for example, there is the person is doing some research. So they will start with doing some research. Okay. Then there is a bit of coding and data mining, data modeling, all of that done. Okay. So we will come to those parts in a bit. Okay. Then there is a backtest done. Now, while doing this backtest, what is the most natural thing? If I ask you as a layman, you will think, okay, if I'm doing a backtest, say for example, on the past 5 years of data, okay, and I'm actually backtesting a model which works on the say 15 minutes time interval. So if you're looking at the 15 minutes chart, somewhere or the other, whenever your conditions are met, say for example, you have a long position, and then when your conditions to sell are met or exit are met, then you have a short position. So you do this on the 15-minute charts for 5 years, and you feel like, okay, in these 5 years, the 15-minute time frame has covered a variety of market regimes or market phases. It has covered the bearish phase. Okay, it has covered the bullish phases, the best of the bullish phases. It has covered the sideways phase and whatnot. Okay, so it must give me very, very good results, because 5 years of data is amazing, right? 5 years of proper backtest is like something which is very robust. But no, what generally professionals do, okay, or I can say they do this 90 to 95% of the time, is that instead of taking 5 years of data, they will take 4 years of data. Okay. And they will keep 1 year of data separate. So if I take a 5 years of data and I will, and if I'm supposed to, after this 5 years of data, I'm supposed to do the back testing, there's a high chance that I will have something called a data mining bias. Okay. There are many different types of biases in behavioral finance. Having some multidisciplinary education has taught me that all of these are interlinked. Similar biases are there in investing also, in trading also. But data mining bias, to be particular, means that if I'm using 5 years of data, after some time I have got the data by heart, or you can say I've got a very good feel of this data, right? All of you agree with me. Some of you have tried it. Okay. We have some people who did not give the introduction because they entered late, but I suppose some of you have tried it. Okay. Okay. If you have not, no problem. I'm going to give you an example today. Okay. But generally what happens if I have 5 years of data, I am going to optimize my conditions in such a way that I end up getting the best result, and I will call it my trading system. And believe me, I have made this mistake. So it doesn't happen like that. And I also don't do it like that anymore. So we split the data into a certain ratio. Say, for example, 80:20 ratio. Okay. So here, in the 80% ratio is called my training data, or train data set where I'm actually creating the model, I'm putting the conditions, and I'm tweaking the conditions to get the best results. Okay. And then 20% data is, which is also called the test data set. Okay, test data set. Here, I'm going to back test this strategy. So for example, this is my strategy, right? I have optimized it on this 4 years of 80% of data. And for this 1 year, okay, for this 1 year, for my model, this data is completely new. And therefore, I get an understanding of how robust my system is or how unbiased my system is if it performs well in this 20%. That is for this 1 year, right? So this gives me a very good idea. So for example, if I was to give a scale of 0 to 10, if my robustness of my strategy is say 9 on 10 when it comes to the train data set, and when it comes to the test data sets, if the robustness of my strategy is say 3 on 10, do you think I have a good trading model? Yes or no? Do you think I have a good trading model? Yes or no? Okay, if you are having any problem in understanding, you can ask me questions. Okay. So I'm saying, repeating myself again, I have taken 5 years of data, trained the model in 4 years, and the last year I made it a test data set. For these 4 years, I got a very good accuracy and signals, and I would say like, wow, this is 90% accuracy. Let's just call it percentage wise. So obviously this is a great model, right? But the moment I run the model on new data, which is the last 1 year, I will say I'm getting a very poor accuracy. I'm getting something like a 30% accuracy. So what do you think? Does it mean the model I have created is good? Does it mean it is good or it is not so good? Answers, please. We have tested 4-year data. Yes, we have tested this 4 year, and this 1 year, which is the last 1 year, I have just used the model which I used in the past 4 years. So obviously it is not good, right? Mr. Rahul is saying it is not good. Obviously it is not a robust model, because that means my analysis over here is very, very biased. Oh, Vibhavri also is using the same word. It may be very biased. Yes. So whenever I'm creating a model, be it a traditional model or a machine learning model, either which way, I will have to make sure that there should be an alignment between the accuracy and the profitability of my trained data set and my test data set. Okay. So when professional traders are actually doing their backtesting, they are not just doing backtesting, they're doing something called optimizing. That means in that period of 4 years, they will optimize their model as much as they want to, but the 5th year, they will leave as new to the data. I'm using a simple example of 4 and 5. The train and the test split could be 75% and 25% also. But I'm just giving you an example which many trainers, the analysts and the people who are training the models do. Okay. So we have got optimizing as an important part of backtesting, because just backtesting itself could lead me to a biased model. But when I'm doing optimizing, I'm actually imagining myself trade in this 1 year where I could have been extremely biased and actually would have made losses. So I'm going through this small test even before putting my money live. Then after the optimization, they will go for paper trading. Now, what do I mean by paper trading? It means that you write the code and you arrange that there is a signal. On the code itself, you say, okay, there is a signal which will either print by or something like that. But that code will not be the execution code. It will not lead you to executing a trade. Okay, so we can, as we normally do paper trading as a beginner trader, a lot of people do paper trading as they learn basic concepts of the market. That is how paper trading is done. by the algorithmic trader also. And after all of these steps, if you have got what you want, then you go for the live trade. So this entire process from end to end is not an easy process. And trust me when I say this, it is not easy, but it is doable. Okay. I started off my career without an engineering or a computer science background, but I learned how to understand these things. And the moment myself being a finance guy learned coding, I felt like I'm sitting on a gold mine because all my ideas I was able to model very quickly and more efficiently than ever. So that is how I started when I transitioned into learning Python and so on and so forth. Okay. So what I mean to say is that, and we are getting into the example soon now, that your edge is something which you will have to sort out. And after you have sorted out your edge, the next thing is to code it on Python. Okay. So we will, use Python to code and we'll do some visualization. The code I'm going to use is going to be simple, easy to understand, and short. I'm not going to do something which sounds like a rocket science because I understand some people are new to coding. Okay. So don't worry about it at all. Allow me to just, share my screen again with you all. One second. Okay. Yeah. So allow me to just share my screen, and we're taking a fresh Python script, and over here, okay, and we're using this to basically code. So let's begin. So as some of you already may be aware of that, okay, all of you can see my empty Python script, right? Jupyter notebook, right? Now, some of you who don't know how to actually, open a Jupyter notebook, etc., don't worry. Those steps can always be asked personally. I will share, the contact details over here later, right? So don't worry about that. So all of you can see. Thank you, Ashray. So let's first import certain packages and libraries which are very important for us to do any kind of quantitative finance work. Okay. Now, these are some basic things which you should know if you're starting off your journey, right? So pandas as PD, which is AS as over here, denotes that I'm using the letters PD as an alias to pandas. Pandas is an important library which helps us to actually put the open, high, low, close data or any kind of data in a tabular format. And this tabular format is going to be extremely important for us. Okay. I'm going to move quickly without getting too much into each and every package. Import numpy is numpy, which is important for our calculations. Then we have, and we're going to use these packages while we are coding, so you will understand. Y Finance as YF. This is the Yahoo Finance API. Import datetime as DT. Okay. And import matplotlib.pyplot as PLT. So here, matplotlib.pyplot is actually a visualization tool which we are going to use. Okay. Now, every time we write a code, we want to make certain efficiencies to our this thing. So generally, when we write a code, we want to write it in a modular format, right? But just for the sake of brevity, I'm going to show less of modular format and quickly get into a particular, this thing that, okay, we should start actually with the direct code, not having the modular format for each and every function, but I'll give you some examples. Okay. So let's take for example that if I have to get the data. Okay, so let's take get data. And before we begin, which I actually forgot, so I hope you all can see my new tab. I'm just going to open trading view, and I have thought of a strategy which I will be sharing with you, and we're going to code this strategy. Okay, so just give me a couple of seconds. I'll just open this, and we are going to try it out on hourly chart of Nifty. Okay. So this is the hourly chart of Nifty. And here I have the Bollinger Band. And here I have a crossover. So this is the Bollinger Band. And this is the crossover. So whenever I'm putting these together, okay. So my agenda is going to be that if there is a crossover and a Bollinger Band upward cross above the Bollinger Band. So the Bollinger Bands are basically three bands for those who don't know. How many of you have a problem with understanding Bollinger Bands? Just give me a quick yes, then I'll explain it a little more details. If you want me to explain Bollinger Bands. Okay. So quickly I will say that there are different aspects of the price we are taking. Okay. So let's take, for example, Bollinger Band. Bollinger Band is basically an indicator, which is a volatility indicator. So when I teach algorithmic trading also, I make sure that I teach each and every bit properly. It's just that today we have some limited time. Okay. So we have got a volatility indicator, right? Now, if you notice that the Bollinger Band has a middle band, and then there is an upper band and a lower band, right? The upper band is generally green and the lower band is generally red, right? So all of that can always be done on the chart. Okay? But the true essence is that while we look at Bollinger Bands, okay, here, one second. So this is just the Bollinger Band and the price on the chart. We see that there are phases where the volatility of the stock comes down. So whenever the volatility of a stock comes down, the Bollinger Band also becomes narrow and narrow, right? And whenever there is a trend, the Bollinger Bands expand. So you see that there is a strong trend, the Bollinger Bands expand and they go bigger, they become bigger. Okay. So this is the general essence of Bollinger Band. So Mr. John Bollinger, who was one very famous technical analyst, and he used this statistical proof that 95% and more of the times, the prices will remain between these bands. Okay. So he found and formulated certain very interesting aspects of the Bollinger Band. And building upon that, we are trying to code a strategy. So one of the aspects he had formulated was that in case of a strong and sudden uptrend, the Bollinger Band will expand, and we will also see that the price has started to close above the Bollinger Band, right? So a close above the Bollinger Band, upper band. When I say the Bollinger Band, I mean the upper band over here, right? The close above it is a bullish signal. Now, obviously, when you see the charts, you will see, sir, is this a bullish signal? But then there's only a small move above this, and so on and so forth. Those kind of questions will come. So what our objective is to use Bollinger Band as one of the conditions. Okay, and we are going to use this condition that when the price closes above the Bollinger Band, upper band. Is that clear to all of you? Those who are asking me, is that clear? Yes or no? Yes. And for those who are new to this, I would say stay put. Don't run away. If you have questions, ask me. Because sometimes students get like, oh, I didn't understand this. What is the whole point? Maybe I'll not understand the next thing. No, you will. You have to just be patient with yourself. Okay. So we've got one of the conditions as Bollinger Band. And now the other thing. So I'm going to remove the Bollinger Band and just show you the crossover. How many of you understand what a moving average crossover is? Can you just give me a quick raise of hands? Most of you, I think, have an idea about moving averages. If you don't, let me quickly give you an understanding. Suppose we take this particular moving average, which is the light blue line you see. Okay, I'm removing the dark blue line for now. This light blue line is a 15-period moving average. Okay, it follows the price, but it follows it more smoothly because it is an average of the 15 plots. You need these tools in order to actually find out what the trend is. Just like in case of Bollinger Band, the aspect of price we were looking at was volatility. Here, the aspect of price we are looking at is following a trend. Okay. Now, there are many very different kind of understandings with moving averages people have. Some people say, oh, if the price goes above a moving average, it is a signal to buy. I don't believe in that kind of thing. Okay. However, I do believe that some moving averages can be very, very significant. Okay. But I don't believe in the fact that something goes above a moving average, then it has to be a buy. So what I personally believe, and I'll share the philosophy, is that suppose I remove the price from the equation, I have only these two moving averages. What does it mean? One is a 15-period moving average. The other is a 45-period moving average, as you can see over here. The dark blue line is the 45-period moving average. So in the short term, if the short-term moving average or the faster moving average, which is reacting more quickly to the price, which is the 15-period moving average, that crosses the medium-term moving average, which is the 45-period moving average. Okay. If the short term crosses the medium term, that means that there is a certain short-term price momentum which has come up. Okay. So here, what I'm going to do is every time there is a crossover, I'm going to consider this as a powerful signal. Every time there's a positive crossover, every time there's a positive crossover, I'm going to consider these as a positive signal. And I'm going to use both of these, put them together to get actually a profitable trading strategy. Are you all with me? Till now, whatever I have said, you have understood both the essence of both the indicators. Yes or no? Have you understood what I have told it? Vipul, Ashray, those who said that they have less background about technical indicators. So Ashray, can I have a question? Which part do you want me to repeat? Okay. Vibhavri is understood. Good. Which part do you want me to repeat? Anyone? Okay. So when there are two moving averages and they cross over each other, okay. So, two moving averages which cross above each other. So which again, Ashray, as you have all recently enrolled for the technical analysis course, you will get it down the line when you watch the videos. So I'm keeping it short. So this is the slower moving average crossing above the faster moving average. Sorry, the faster moving average crossing above the slower moving average. यानी कि 15-45 के ऊपर चल रही. Right? That means that the short-term momentum is overwhelming the long-term momentum. Because a 15-period moving average will change quickly, 45 will change slowly. Compare it. Right? So if you have understood this much, that whenever this cross happens, it is bullish. And whenever this cross happens on the downside, it is not so bullish. Right? So I'm going to use that. Light blue will cross over dark blue. I said, Vipul. It is a sign of change because it is inevitable. Like say, for example, in the short term, if there's a sudden price change, it will be somewhere there indicated by a positive crossover, right? So since I'm looking for a strategy which is a long only strategy, I have used this as one of my indications. Okay. So two indications I've used, and it's very, very simple. Okay, if light blue will cross above, it is bullish. So yeah, over here, this we are taking as a bullish condition. I will not call it a bullish signal. I will call it a bullish condition. So through the condition of Bollinger Band, principle and through the condition of these crossover principle. Let us find out if we can create a trading system and how the results are. Is that understood? All of you with me? Ab tak jo bola samajh mein aaya? If there is any gap, feel free to ask. Right? Perfect. So what we are going to do is we are going to get data, and I'm going to just define I'm sorry. Yeah. Get data, and within get data, what I'm going to do is I'm going to pass on certain arguments so I can reuse this code. Okay. So over here, when I'm doing get data, so I'm doing writing symbol. This symbol is going to be something which we use as a ticker symbol of Yahoo Finance. Then I will write start. Then I will write end. Okay. And within this code, so my general this thing would be to get hourly data. Okay. Now, YF dot download, as you saw earlier, I had actually called Y Finance library as YF. So using the YF dot download, I'm going to actually put symbol first. So whatever symbol we put in this function will be there. Start date will be in the start. Then there will be end, and there will be something called interval. And interval is going to be 60 minutes because we want hourly data. So we want 60 minutes. In the end, this is going to return a data frame. Okay. And I'm going to say that this is equal to a data frame. So data frame, or DF for short. I can use ABCD, I can use Mohawk, whatever, but I've just named this variable data frame. So DF, in this DF is stored the entire data for 60 minutes for the particular symbol, for the start date and the end date, and the interval is going to be 60 minutes. So this is what we are going to see happen. Now, let us do that for Nifty hourly. Okay, just a second. Just clean my screens for now. So, yeah. Okay. So, for Nifty, let's say DF is equal to get data function. And for Nifty, the symbol is NSEI, a hat in front of NSEI. What will be the start date? What do you think we should keep the start date? If I keep the end date now, I'm not going for a train and test. I'm going for a basic approach to explain all of you. So I'm going to keep the start date, say 1st of July 2021. So we have 2 years of data, 2021, July 1st, right? And so in the place of start date, I have put this date. And for the end date, let me put now. So what I'm going to do is dt.datetime.now. So this is the method to actually call now, right? And I'm going to run this, and whatever is coming will get stored in this data frame. Let's see how it works. So I have run this, and it is saying, oh, oops, I made a blunder over here. This should be DT. Now it should run. Okay. So download is complete. Now let me plot the data frame as df.head. It will give me the first five rows. These are the first 5 rows. Open, high, low, close. And let me just do a df.tail so you all can understand how the data towards the end of the data frame, end of the entire table is coming. So we see we have started with the July, okay, of 2021, and we have come here till I think day before yesterday, Friday, right? So we have come here till 3:30, which is the market close. And you can see that the difference between each and every timestamp is 1 hour. All of you are clear about this, correct? This is simple, easy to understand. Those who are new especially, give me a quick thumbs up or a quick yes. Now, upon this data, thank you, Mibabri. Thank you all for the interaction. I hope, people have not slept, because sometimes this sciencey things can be a little boring for somebody who's not used to it. So, okay. But I'm telling you, trust me, this is one of the most interesting things we are getting into. Now, let's define a function just to make it easy for us, right? So let's call it coding underscore MA, where we pass the data frame itself. And what I'm going to do is I'm going to show you a shortcut to actually plot all the moving averages I need. So I have a variable called MA underscore list. So what are the moving averages I need? Can you all tell me? Can you all tell me what are the moving averages I need? One I'm telling here, 15. What else? Okay, I need a 45. And I need a 20 period moving average. Okay. Yes, thank you. For 20, I will need, because I want to later calculate the Bollinger Bands. Okay. So this is MA underscore list. And now let me write a for loop so that I don't have to go separately and code each one of them. I can make this list as big as possible. So for MA in MA underscore list, DF, let's say the MA means that for every time it goes through the list, whatever it is, I will call MA. So I'm going to write a string. That means I'm going to convert this into a string MA, plus, let me just write underscore moving average. Okay. So it makes it easier to understand, is equal to DF close dot rolling. What is the period of rolling I want? The period is MA itself, right? And what is the rolling dot mean is the function. So you see, every time I'm calling this MA first, in the first iteration, it will take 15. It will call itself 15 underscore MA, and it will create a column. And for every iteration, it will create a new column. And in the end, it will return the data frame itself. Okay. So let's try one thing. We already have our data frame. Now let's try df is equal to coding underscore MA and pass the data frame which I already have, which is this. Okay. And let's see how magically we can find df.head, and we can find that we have got three moving averages, 15, 45, and 20. Now, why do you think there are this NaN written over here? This NaN is basically the not a number values. And in our code, for our backtesting to be smooth, we won't want something which has got not a number values. So after this iteration, what I will do is I will simply df.drop NA, that is drop all the not a number value, the entire row will be dropped, right? And in place equal to true makes it permanent. So now you will see that not a number values have gone away, but we are starting with a later date. We are not starting with the earlier date as we did. Okay. Here df.head was at the 1st of July, but here it has come to the 9th of July because we have eliminated all the rows which had not a number values. Are you all with me till now? Okay. So we have completed the work with one indicator. Make sense? Now let's quickly come. If you have any questions, feel free to ask. Let's come to another indicator. So I'm not going to create this DEF and return anymore. I'm going to make it a little quicker so that you can understand in a simpler way. But what happens is why we have a DEF, so that every time I'm defined a get data, every time I can use get underscore data, instead of NSCI, I can put Bank Nifty, I can put Tata Steel, I can put any other stock. I can put some stock from the US exchange also. I don't have any problem. Okay. So to make the code more reusable and not to repeat the basic stuff, we make our code more modular in nature. There is something else called object-oriented programming. So in object-oriented programming, especially when people are doing collaborative research and they create their own libraries and their own classes and their own modules, there they will use OOP to make it even shorter and quicker. But that comes at a later stage, not for the beginner stage. Right now, if it seems overwhelming, trust me, it will get easy with time. So let's understand, we already have the 20 moving average. What do I need? I need the Bollinger Band. So let me call the upper Bollinger Band, which is basically two standard deviations. So DF 20 underscore ME. So after the 20 moving average, above that we have to go to standard deviation. So I will plus add 2 multiplied by DF, close dot rolling 20 period dot STD is for standard deviation. Okay. And a closing bracket. Understood this? So now if I put df dot head, I have got a column for my standard deviation. And of course, we can always do df dot drop NA in place equal to true. Got it? So this is the general essence of things. Okay. Now let's move on. Let's understand. Now I need to put some conditions in my code. I have got my data frame. But before I move to the condition, actually, I generally do it at every step, but just to not interrupt the process of calculation, I did not do it. So let me plot the closing prices so you can understand that how the Nifty chart looks like on the hourly for 2 years. So for 2 years period, this is how the hourly chart looks like. Okay. This is the hourly period data. And on this data, we are going to backtest our trading strategy. Now, let us understand this. What is our trading strategy? Our trading strategy will be met when the conditions are met, right? So what are the two conditions we are going to take? The first condition we are going to take is going to see that there is a green candle, like a closing candle above the Bollinger Band upper band. So every time there is a candle which is above the Bollinger Band upper band, I have one condition which has met. And the second condition is whenever there is a positive crossover, that means the 15 period moving average is above the 45. That is the second condition. How do I code these conditions? So let me just show you on the whiteboard, just for making it easier for you. Okay. So let's take, for example, here you can see the whiteboard. Can you see the whiteboard now? I think you can see. So we have got the, we have got the data frame, okay, which is basically a table. Now it has got open, high, low, close, okay. So let's say it has got one of the columns as the upper Bollinger Band. We have just calculated it called upper. So I'm going to say that let's create another column and let's call it cross underscore upper. Okay, we are going to do that just now. And let me code something like every time the closing price is greater than the upper band, we will encode this as 1. And every time the closing price is less than the upper band, I will enclose it as 0. So every time if something is above the upper band, it will be, and it is trending very strongly, then you can see a number of ones. Then again, you will see 0, 0, 0, 0, 0, 0, 0, right? And so on and so forth. You can only see probably 1, 1 sometimes, and then again it comes to 0, right? All of you are getting this. A close above the upper band can be encoded as 1. All of you with me, just type a quick yes. right? Now, thank you. Now, what is the second condition? So we have got the 15-period moving average, we've got the 45-period moving average, right? Now, let's understand this. This is a game of logic, and this is the baby steps. You will love doing it. If you are an enthusiast of logical thinking, mathematics, you will just love doing this. Trust me on this. And incidentally, what you will love doing, it can make you a lot of money. Okay. So, if 15 moving average value is greater than 45 moving average, right? But here there is something which I would add on, which people don't get in the beginning. That is that many times there will be a noisy market, and probably the 15 and 45 can intertwine for a while. So it is not that once the crossover has happened, it will always continue. So same for the cross upper also. The condition is going to be multifold when we write the condition. We have to write condition, which is one, but we have to write two parts. One is that one second. The close should be greater than upper. That is important part. And in the previous, so if I'm looking at the first data point, it doesn't stand for that, but I'm looking at something in the middle. If close is greater than upper, but in the previous iteration or the previous row, the close should not be greater than upper. Then I have discovered that there is a cross happening. So that is where the cross underscore upper happens. Similarly, when there are two moving averages, 15 and 45, if I have to find the crossover and encode it as 1, so every time 15 is above 45, what I'm going to do is I'm going to see what is the point where 15 has gone above 45, but in the previous iteration, 15 was below 45. Okay, then I will encode it as 1. So I'm looking for the cross to happen. Are you all with me on this? Okay. Are you all with me on this? Okay. So when we code it, you will understand it better now. Okay. So let's understand this. And if you have any questions, please ask. Cool. So allow me to share the screen again with you all. Now what we are going to do is we are going to code the conditions. So what is the important condition right now to be coded? So one second. Let's code first the crossover. Okay. Now every time I have something going on in the data frame, I iterate over it, right? So I don't have to go through it again. If there is a data frame which has got columns, I do the calculation. This is called the vectorization format. I do the calculation for one row at a time. And this entire thing replicates for all the rows the moment I write this new column. Just like we did the creation of these, moving averages and all the indicators. So let's talk about the crossover first. So I have creating a new column called crossover. And I use something called np.where. np.where, the syntax may be new for some people. But this means that we are trying to find out where, as in English language, where has this happened? Where has this happened that the DF 15 MA is greater than the DF 45 MA? Where has this happened? You tell me. Okay, but this is not enough, as we discussed earlier. So what we will do is we will put two conditions. One, that this is there, and another condition that DF 15 MA dot shift matlab you went to the previous row. In the previous iteration, it was actually less than DF 45 underscore MA dot shift to this again. Okay. So let me just put the underscores, otherwise there will come an error in my coding, right? So here I have put the right syntax in the right column names. And if these two conditions are met, I have put condition 1 in a bracket, put an AND operator, and then I have put another condition, both these conditions basically. So whenever this happens, if these conditions meet, then 1. If these conditions don't meet, then 0. So this is where I have created this thing. So I think there is a bracket missing over here. Oops, just a second. Just a second. Second. So df, this is greater than this. Is condition number 1. Dot shift. This is the base and this bracket. So now done. So when you're coding, small mistakes here and there are just a part and parcel. So we have got a fresh df.head. Now you will see the first will be a, here you see the crossover column is created. And you will see this is 0, 0, 0, and then suddenly there is a 1. Okay. So that means that over here there was a fresh crossover. Are you all with me till now? I'm again asking because there are, there is no question being asked from the audience. So maybe it's too easy, like, making it good enough to understand, or maybe it is a little going above head. That is why. Okay, you understanding. Good, good, good. So moving on. Let's plot the second condition, and I'm going to do it here in this cell itself so that the conditions are together. Let's call it cross underscore upper, right? And we use the np dot where again over here. And here, what do we want to? Here, what do we want to do? Here, what we want to do is we are going to, no problem, Ashley, you can just catch up on the recording later. Here, what we are going to do in np dot where is I'm going to segregate those points, those places where there's a fresh close above the upper band. Now, if you see, I've already got the upper band column as upper over here. And now I have to create a condition. So same philosophy I'm going to use. First, I'm going to put condition number 1. Close is greater than df upper. So it is greater than upper band in this particular data point or this particular part of the chart. And then at the same time, so df close dot shift, that means I'm going to the previous iteration, was less, not greater, but less than the upper band. So it was below the upper band earlier. Now it is above the upper band. If these conditions are met, please encode this as 1. Otherwise, you encode this as 0. I'm telling my system to do that. Okay. So I think I have put the brackets correct this time. Yes. And if I do df.head again, after running the code, I'm seeing a fresh column called crossover. So all of you are clear that we have created our conditions. Now, once we have created our conditions, we need to see the data frame with the conditions. And we need to see that I want to go long, take a long position when both these conditions are met. So Ashray is asking, what is the difference between 0? What is the reason to have 0 and 1? The reason to have 0 and 1, Ashray, is that I have a yes or a no. 0 and 1 acts over here as a yes or a no. So every time 1 is there, then I mean that yes, this condition is met. Every time 0 is there, this condition is met. Now, while doing the back testing, since I'm using both the conditions, what I'm going to do is I'm going to merge these two conditions and put a condition like if this exists as well as this exists at the same time. Are you with me now? Do you understand what I'm saying? Okay. So in order to code through this every hour data, what we need to do is we need to create a for loop. Now there are multiple approaches and multiple frameworks to doing this. It takes an understanding, it takes a while, but this is one of the approach. It is a simple framework which I'm teaching right now. So please pay attention, but it is something which is effective and it will stay with you forever if you come into this, come to this field of work. Okay. So I'm going to create a for loop. So before I create a for loop, what I want to do is I want to create a small variable. It will be called POS, short for position. So in the beginning of our back test, the position on the current position is 0. That means there is no long position which is there. As I said, this is a long only strategy. And one thing which I forgot to say, I'll keep a very simple rule for my exit. This was my entry. For my exit, what I'm going to do is I'm going to, as soon as there is a close below the 20 moving average, I will exit the stock. Fair enough? As soon as there is a close below the 20 moving average. So for example, these are the two moving averages. There's a crossover. Suppose this is an entry. I've not put the Bollinger Band, but suppose this is an entry. Okay. Now the Bollinger Middle Band, this small light gray area is the 20 moving average. So price closes below this, I'm going to exit. Okay. So, let me just show you this. So I'm going to plot this for you so you can understand what I'm trying to say. Right? So this is the 20 period moving average. Since it's 2 years of data, it is seeming so big. So let me just take the past 1000 hours of data. And, so this is the 20 moving average, right? So whenever we see a buy trigger, the first instant when it goes below the 20 moving average, we take an exit trigger. Okay. So that will be our system based profit taking or stop loss taking, whatever you want to call it. Okay. So let's come to the iteration, to the for loop. So first we write POS is equal to 0. That is to say that we are storing whatever the position is as 0 in the beginning. And I'm going to make a list called returns. Okay. Returns is a empty list. Also, at the same time, what I'm going to do, I want to create a new column. And I want to call that column positions. Why? I will tell you later. Okay. But later I will store a 1 or a 0 depending of we have a position in it or not. Okay. So how do I create or initiate an empty column? Within the DF data frame, I have created the new name called position, and currently it is an empty. So it is called empty.nan. Okay. Now, through the DF, I have to go through each and everything through the DF, right? So I will do what is I have to say for I in df.index. So through the df.index, I'm actually going to iterate. That means what? That while there are a number of columns, there is an index column. In this case, the index column is actually the date time column itself. So it is going to iterate through each and every part of the index. And sorry, this bracket should not be there. And here the for loop starts. So first thing I want to do is df positions ith position is equal to the integer value of the variable POS. Now I know some people find it too much jargon. Don't worry. We are going to just tone it down as much as possible, but I have to teach the backtest, right? So if you don't understand these things, you can always learn these things. I myself have a course on algorithmic trading, but you can always learn these things. Okay. So every time there is a position to initiate that as POS, I'm going to write 0 or 1. Okay. So DF positions, ith position is the integer. So every time the integer value is taken. Now, let's understand this. Suppose the conditions are met. How do I quote the fact that my conditions are actually met? So I'm going to say that if positions is 0, so if POS is equal to 0, whenever we have a comparative, we write a double equal to, right? And at the same time, what is the condition we were looking at? We were looking at a cross upper. Okay. So let's look at this. Df cross underscore upper, right? And the ith value of this cross upper is equal to 1. Okay. So for the sake of, because some people are telling me it's a bit difficult to understand. So for the sake of ease, what I'm going to do is I'm going to just keep this condition. I'm not going to keep the crossover condition. Okay. So for the sake of this, so every time we go above the Bollinger Band on the upper side, what we do is whenever this happens, we make the POS is equal to 1. Okay, so the position equal to 1, and we call the entry as the ith part of close. This is the entry. So in this row, in the ith row, whatever the close is, that becomes an entry point. Okay. So when these conditions are met, we have taken the entry. Now, for example, POS equal to equal. Now the exit condition. Suppose there is already a position. That means POS equal 1. Okay. If there is already a position. And what was our exit strategy? Our exit strategy was wherever in the data frame, okay, the close is less than 20 underscore MA. And for both, I want the ith level. So I have to keep in mind that I make no mistake while doing the backtest code. But once you have this framework ready, a lot of life becomes easier. And you can make complex, when you are using complex strategies, you can make some modifications, you can add a lot of conditions. But for a basic strategy, this much is enough. Okay. Now, every time I have the exit condition, at the same time there is a position equal 1. I need to tell the system that now let's make the position equal to 0. Back to no position. And denote the exit as a exit price as the close. Okay. So this is something which I want to do, right? Yes, this is the stop loss. I'll come to that. You will see how. So every time, let's say for example, this is the upper band, right? So when something has gone above the upper band, and I'm saying that this part, this gray area, okay, you can see the chart, right? This gray line is the 20 moving average. If something is above the upper band, closing above the upper band, it is obviously above the 20 moving average. You can take any situation, okay? So the 20 moving average is the exit. Now, if the trend continues, the close below 20 moving average will come over here. But if there is a stop loss, then the 20 moving average will come over here. Getting the point? By inevitably, price will be above 20 moving average in the entry. So 20 moving average will be our exit, be it target or stop loss. Have you got the idea what I'm trying to say? This is something new for even people who know a bit of technical analysis. But if you use basic logic, you will understand. Upper band is always greater than the 20 moving average. So entry ऊपर में ही होगी. So 20 moving average नीचे आ गया. Now the trend is moving on and on and on. It is extending. Then there is a close below 20 moving average. We're still making a profit. Are you all with me on this? Vipul, Vibhavari, Ashray, all of you with me on this? Right? Got it? So I'm keeping it very simple because here I'm here to tell you a framework, right? And this is how many logics come about because mathematically it is impossible for it to be above moving average, above a upper Bollinger Band and not be above moving average. But good question, Ashray, because at least that thought process you had, that where is the stop loss? Nothing wrong with that. Okay. So we have stored the entry once we have taken the entry. And when we already have existing position, and we have the sell condition met, we are making the position 0 and we are calling this closed where we have got that, okay, this is the exit. We'll call this the exit. And now we have to calculate a return. Let's call it R. Now, what is R? R is basically, let's take for example, I'll use my whiteboard for a second because this is important. So for example, I have bought a stock at 100 rupees and I have sold it at 105 rupees. Okay. What is my percentage return? Anyone? So whenever we do algorithmic trading and backtesting, whenever we do that, we calculate and focus on the percentage return. We don't go for the absolute return, because if I'm doing a 5-year backtest and Bank Nifty was 18,000 at one point of time and now it is 44,000. If I look at the percentage return, it will make more sense. If I look at something which is only absolute in points, then 1% movement in Bank Nifty is 400 points or more than 400 points. So you see, it is easier and more logical to take percentage return for every return on trade, because the price can move. So absolute numbers can change a lot over time. So what we do is, if the entry is at 100 rupees, exit is at 105. A 5-year-old child cannot, not 5-year-old, but whenever you learn maths, you can easily say the return is 5%. So how do we calculate it? We will simply take the exit price divided by the entry price. So that will be 105 divided by 100. So you will get something like, what will you get? 1.05. So we will do what? We will do -1 and we will multiply the thing by 100. Okay. This way we will get the percentage return. Okay. So simply that we are going to do now. So R is equal to exit. And if the exit is a smaller number, in the sense it's a loss, then it will give us the negative percentage. That is also fine. Exit divided by entry. -1 and multiply it by 100. And in the end, what I'm going to do is, remember I had created a list, an empty list for returns. So every time I exit a trade, I'm going to, this list, which is called returns, I'm going to append it. I'm going to add a number to it, which is whatever the returns is. So whatever percentage profit or loss is there, this is appended. This R is appended into it. Now, every time I'm doing the back testing, it is going to iterate through, loop through each and every of the rows. Okay. And in the end, what I can do, I can print, like people do a lot of things. I myself do a lot of things. Okay. You'll see some different frameworks I have on my YouTube channel also, right? But I myself do a lot of things, but it's important to understand what you're doing. So for easiness sake, what I'm going to do is, in the end, after the for loop, let's get out of the for loop and just simply print the returns. Right? So let's run the code. I hope this works out without any errors. Sometimes everybody makes errors. Okay, I made some error. Oh, this is a warning. I have not filtered the warning, so that's okay, not a problem. So here we have got filter warnings is something, again, don't have the time to explain, but yeah, here I've got all the returns. Okay. So you see some really huge numbers are there, but all of them are after a certain point, like, it's after a decimal. So let me do one thing. I'm going to use the function over here to make it a round number. So I have got R. So let me append round figure of R with 2 decimal places. So that makes my life easier, and the the returns here, the calculation is going on. Yeah, the returns are more neat and clean to see. So you see, I've got a 1.82% return on a trade, right? I've got a 0.73% return on a trade. I've got a 2.48% return on a trade. I've got a 1.1 minus percent, like, the loss on a trade. Okay. So what I'm going to do is, since I already have this returns list, let me convert this returns into a pandas data frame. So simply what I will do is, let me call this P&L is equal to PD dot data frame, and simply put the returns list as an argument over here. Now the P&L looks like this. It has a 0th column, which is the 0th number column over here, right? And I can see that there are about 54, actually 55 trades taken over here because we started with 0. So we have 55 trades taken over here. Now let me see how P&L 0 has given me the returns. For this, what I'm going to do is I'm going to take a cumulative sum and I'm going to write how the cumulative sum looks like. So the cumulative sum looks like this. So every time there's a profit, it gets added. Every time there's a loss, it gets subtracted. And total cumulative system is 15%. Okay. And if I was to simply plot this cumulative sum right over here, let me do this. The equity curve looks like this. So in a matter of 2 years, this strategy has given me 15% returns. Okay. Doesn't seem very great. Okay. But here it is important for us to get the framework. Also, I need to see if after these 15% returns, can I take leverage? If I'm trading Nifty futures, I can take leverage. So if I take, the market gives me about 5 times leverage, sometimes 6, okay, depending on the volatility of the stock. But suppose I have 1.5 lakh rupees. I can trade the Nifty contract, which is about 9 lakh plus, right? So I get a significant leverage, about more than 5 times in the market. So what I need is I need to make strategies which in the back test, in the forward test, go and show me a robust return. And that robust return is going to give me a good understanding, right? So this was a small example, and I know we have overshot the time, but if you have 2 minutes, can I show you something? If you have 2 minutes, okay, because I have something to show you, like a couple of things to show. So let's just do this. If you have understood this, okay. So what we are going to do is we are going to first create a basic return so we can compare the strategy and the buy and hold return. So let's call it BNH, just to keep it short, right? So we are going to say df.close divided by df.close of the previous. So when I teach this to students, I start by showing it slowly in Excel, and then we graduate to these things, right? Because it is not easy to understand this in the first way. And we take the log returns. So this will give us the log returns on the daily basis. And let's create a DF called STR, which is the strategy returns, which will simply be DF positions. Remember, we had created a positions column, which was either 1 or 0, and DF dot close. I'm sorry, DF BNH. Okay. So every time there is a position which is 1, and the Nifty also gives a return, that return will be replicated by a strategy. Now what we are going to do is we are going to take the BNH and we are going to take the STR and we are going to plot the cumulative sum, of these numbers. Voila. So this is our buy and hold returns versus the strategy returns. We can obviously make the graph look more neat and clean, and visualization is a subject altogether on its own. But this is how it looks like, right? So we have got the strategy. Maybe it is not creating a lot of alpha, but it is slightly more stable than Nifty itself. And it is creating actually less than alpha, to be honest, if we look at the market currently. Okay. Now, going forward in the next coming week, actually, like, the 1st of July, we are starting a batch on algorithmic trading. And it is a course which is going to be very robust. It is going to have a number of sessions which will be there. So what you can simply do in order to understand this, you can go to technicallysorted.com. The official number is also